Hey, what's up everyone, and welcome to the School of Personal Finance. So I want to say a quick thank you. I just hit 10,000 subscribers as of last night on this channel. For everybody that's part of the community and supports me, I appreciate it very much. If this is your first time here, I talk all about personal finance and helping you become great with money. So please consider hitting that subscribe button and joining us on this mission here. So in the last few weeks, I received a couple of questions asking my thoughts around having a 15-year mortgage versus a 30-year mortgage and investing the difference in either retirement accounts or a brokerage account and trying to save for your future. So now this is a very difficult question to answer, and it depends on many different things. If you're a math geek out there, then you might just be thinking to yourself, it's actually a very simple answer, because if I could get a higher rate of return on my investments compared to the interest that I'm paying on the mortgage, then I should always invest that money. But it's not that simple. So in this video, I'm gonna go do a little deep dive into my thoughts around it. Hopefully you find this helpful. Let's get to it. All right, so the question is 30-year mortgage where I'm gonna pay a higher interest rate. It's gonna take me 30 years to pay it off, but I'm gonna have extra cash flow each and every month to go ahead and invest for my future. Versus a 15-year mortgage where I'm gonna get a lower interest rate on the loan. I'm gonna be done in 15 years, but I'm gonna be strapped for cash. I'm not gonna have that extra cash flow each and every month to go ahead and invest for my future. Which one is better? So here are some of the things that I consider when trying to make a decision around this. The first one is your age. So I believe the younger that you are, the more it makes sense to have a 30-year mortgage. And the reason for that is because in your younger years, the more you could invest in retirement accounts or in brokerage accounts for your future, the longer time horizon that money has to compound and grow, and the more aggressive you could be with your investments, where you have a better opportunity to get a higher rate of return. So if you're in your late 20s or your early 30s and you're just starting a family, I think a 30-year mortgage and investing the difference makes a ton of sense because you're giving it a long time to grow. And on top of that, the flexibility that gets added to it. So if you lock yourself in to a 15-year mortgage and life happens and you're stuck to that payment, it might put you in a bad situation. So the flexibility of a 30-year mortgage, especially in your younger years, I think it makes a lot of sense. But the closer you get to retirement, obviously, the less you want to owe on your house. So if you're in those later stages in life, having a 15-year mortgage, I think it makes sense. And also, when you're in these later stages in life, you're probably investing more conservatively. So maybe you'll be lucky to get a 5 or a 6% rate of return on your investments compared to somebody in their 20s where they could go for it and they could invest very aggressively and get an 8 or 9% rate of return on their investments. The second thing to consider, and I just kind of touched on it, is how you'll invest the money. So if you're very conservative, if you have a low risk tolerance, then doing a 30-year mortgage and investing the difference might not make that much sense. But risk tolerance, that's a serious conversation that you have to have with yourself, and there's no risk to paying off your mortgage early. You're getting a guaranteed rate of return of whatever the interest is that mortgage is charging. So if you have a 3% mortgage, then every dollar that you put in there, you're getting a 3% rate of return because that's 3% of interest that you wouldn't have to pay on that. Where if you decide to invest the excess cash flow, there's a lot of variables involved in there. If we go through 2008, 2009, you could have lost 40% of the money that you put into that investment. So there's no guarantees with investing, and it's a roller coaster ride. Another big question to ask or thing to consider is, can you get the rate of return that you're using in your calculations? So in the example that I'm about to show you, I use a 6% rate of return. But you know what? The average investor, they usually don't get a 6% rate of return because they usually do the wrong things most of the time. So when the market's really high, they try to buy more. When the market's really low, they sell out, they get scared. And the average investor, they probably don't get the average. So it is something to consider how disciplined you are, and are you going to stick with the investments over a 30-year period where you'll actually get the rate of return that you're using when making this decision. And then the next thing I would consider is the psychological piece to it. If you're the kind of person where it just makes you feel so warm and fuzzy to think about not having a mortgage and being debt-free, not owing anybody anything, and there are plenty of people like that, and how could you argue with that? That would be a great feeling to not owe anybody anything. If that is your drive and your motivation and you're going to go for it, then that's great. then go for it. And for you, I would say do the 15-year and attack that thing as quickly as you can. If you have a different mindset where you just want to save and invest and have this huge pile of money that you could pull from and that you could do whatever you want with, even if it means paying off the mortgage at a later date, stroking the check out of there and paying the whole thing off in the future, then maybe investing is the better option for you. If you like the stock market, if you enjoy investing, if you like real estate, then that might be the better way to go for you. And another thing to consider is inflation. Now, inflation is not the easiest topic to wrap your head around, but I would much rather be paying money back many years in the future rather than paying it back now. A dollar today is worth more than it's ever going to be worth, and that is because of inflation. So for example, 30 years ago, you could buy a piece of pizza for $1. Today, it takes $3 to buy that same piece of pizza. The pizza hasn't changed. It's just the value of the dollar has gone down. So if I'm paying back money on a mortgage, if I owe you money, I would much rather pay you 30 years from today rather than pay you today. If I have a $2,000 mortgage payment, 30 years from now, it's really only going to feel like a $700 payment. It's not going to hurt my pocket nearly as much because the prices of everything around me will have gone up. Where my mortgage payment, that is going to be staying the same. And obviously in this video, I'm not taking into consideration taxes and insurance. Those will go up with inflation. I'm just talking about the principal and interest payments of mortgages. So inflation is a big part, and it's like what the government does. The government wants to borrow as much money as they possibly can for as long of a period of time as they possibly can because they know that they're going to be paying it back many years down the road with money that has been devalued tremendously. So borrowing money at very low interest rates for very long periods of time, that makes a lot of sense to me. All right, so now let's look at the math because the math is important and it is a factor. And then after that, I'll go ahead and share with you my personal opinion and what I've decided to do in my life. All right, so let's compare two $400,000 mortgages. One's a 30-year, one's a 15-year. The 30-year, the current rates are right around 3% right now. And for a 15-year mortgage, they're right around 2.5%. So let's start with the 30-year. So 30-year mortgage, 3%, $400,000. The monthly payment is $1,686. So now let's compare it to the 15-year at 2.5%, where the monthly payment is going to be $2,667. So that is a difference of $981 a month. So now let's say that you are a nice, disciplined investor and saver, and you're going to take that $981 and you are going to invest it for growth in the stock market for your future. And let's say that you get a 6% rate of return on your investment. You would have $285,293 in that investment account 15 years later. And now you still have a big balance on your mortgage. So at the end of 15 years, you would still owe $244,202. But now the amount in your investment account, that is $41,091 more than the amount that you have on your mortgage. So in reality, you could stroke a check, pay off the mortgage, and still have that $41,000 left over. Compared to the person that's doing the 15-year mortgage, at the end of 15 years, they don't have any money invested, but they don't have any mortgage. So they're starting fresh. So in this case, so far, doing the 30-year, you come out ahead by $41,000. All right, so now let's keep going for the full 30 years. So now the first scenario where you have a 30-year mortgage, you're just going to continue investing that $981 per month into the investment account. At the end of the 30 years, you will have $985,429 in that investment account. And now the person who had the 15-year mortgage, they don't have the mortgage anymore. So now they could take that whole monthly payment that they were making of the $2,667 and invest that over the next 15 years. And at the end of it, they would have a total amount of $775,614. So that is a difference of $209,815. So in this case, it's pretty obvious that the one that did the 30-year mortgage, they came out well ahead than the individual that, put all their money towards paying down the mortgage in 15 years. And if you think about it, it's obvious, right? Because the person who did the 30-year mortgage, they were able to go ahead and invest and get a 6% rate of return on that excess money, where the person that's paying the 15-year mortgage, they were dumping their excess money back into the mortgage where they were only paying a 2.5% interest rate. If we're just looking at the math, it's always going to make sense to put your money where you get a higher rate of return. But nothing is guaranteed. So there's a lot of other factors that come into this. And if I threw a third option in here, which might be much more realistic, say we have somebody who does a 30-year mortgage, and instead of investing that whole difference of the $981 a month, they really only end up investing around $200 a month because they spend the other money on life and things happen and they want to put a pool in their backyard and they want to upgrade their cars and they have more kids that they're spending money on. So they really only end up investing $200 a month over that 30-year period. That person, at the end of 30 years, they'd be done with their mortgage, but they would only have $200,000 in their investment account. So that obviously is worse than all of the above. And that one is probably closer to being more realistic than somebody taking all of the excess cash flow, the $981, and investing that each and every month. It's pretty hard to do that. So, maybe it's all somewhere in between, but hopefully that gives you a little bit more perspective that it's not just cut and dry. It just doesn't always work out the way that you planned it, especially, over a 30-year period. All right, so I talked about things that you need to consider when making this decision for yourself. I went through the actual math and showed you how a 30-year is basically always going to come out ahead if the rate of return that you get on your investments is higher than the interest on the mortgage payment. But now I want to talk to you a little bit about my personal opinion and what I personally do in my life. So I have chosen the path of letting my mortgage go. I have a 30-year mortgage. I'm just going to pay it on the amortization schedule for the 30 years. Maybe later on I'll start to accelerate that. But right now I would rather invest the money. I'd rather invest the difference. I would rather have the flexibility of having the investment account, having that extra money, especially, the decision was much easier in my younger years because you need that flexibility. You don't know what life is going to throw at you. If you strap yourself so hard to do a 15-year mortgage and you penny pinch and you don't enjoy life at all, I think that that's the wrong way to go. So I would rather have the flexibility of the 30-year mortgage, enjoy life a little bit, but also try to save and invest as much as I possibly can. And now as I'm getting older, I'm starting to rethink it a little bit and thinking that maybe I do want to accelerate the payments on my mortgage, but I'm not there yet. So I think I still have some more time where I'm just going to continue making this 30-year payment and seeing where life takes me, but try to continue to invest in the stock market and in real estate and in other things that I think will grow my wealth much bigger than me paying down the debt on my house. So now when it comes to other debts, that's a whole different ballgame. I'm not talking about credit card debt or high interest student loans or car payments. That is different. I'm just talking about, the mortgage debt and my feelings around that. So I've personally chosen to do the 30-year, invest the difference, and inflation is another very big reason for me. And I do this on my rental properties as well. I do 30-year mortgages. I let the tenants pay down the debt. And 20 years from now, 25 years from now, that mortgage payment is going to feel like such a small amount compared to the rent that I'm going to be getting on the house, because the rent is going to be going up each and every year where my mortgage payment is staying the same. So why do I want to take today's more valuable dollars and pay down that debt when I could take 25 years from now less valuable dollars and pay down the debt then? So that's my personal opinion on it. And again, it really is such a personal decision, and it comes down to you and how you feel about these things. And if you're ultra conservative and you don't like risk and you don't like taking chances and you want everything to be certain, paying down your mortgage faster, doing a 15-year mortgage, throwing any extra savings at it, it makes a whole lot of sense. You just have to be aware that you might not have that much access to money. It's hard to get money out once you pay it into the mortgage. You could get home equity lines of credit to have money available, but you want to make sure that you really have enough savings in an emergency fund and in the bank where if something were to happen, you don't have to do a cash out refi to get money back out. That is it for this one. I hope that this was helpful for you. Please, again, make sure to hit that subscribe button. If you have not subscribed yet, hit that like button. It helps so much with the YouTube algorithm. I appreciate you being here. Shoot me an email. If you have any questions you'd like me to answer in the future video, email me, rich@schoolofpersonalfinance.com. Go over, check out my website. See, there are different ways that you could work with me. If you'd like to hire me as your financial planner, I'm taking on new clients now. Thanks a lot for being here. I'll see you again next week.